At this exact instant, there are countless Americans, retired, diligent folks who followed all the rules, sitting completely oblivious that the funds they've been safely stashing in their checking account could be silently setting off a fresh IRS review procedure. And here's the piece that no one in your household, your bank, or your money advisor has probably shared with you yet. There's a particular dollar figure that once you go beyond it, places you squarely under a magnifying glass. And if you happen to be retired, the consequences aren't merely irritating, they can be financially crushing. If this is news to you, stick with me for the coming minutes because what I'm about to reveal could genuinely spare you thousands of dollars and a great deal of anxiety. So, let's begin from the top because this story genuinely counts. For generations, Americans were taught one basic rule: keep sufficient funds in your checking account to handle your bills, your surprises, and your peace of mind. That was the conventional guidance. That was the cautious approach. Banks adored it. Money advisors pushed it. And retirees particularly embraced it because after a lifetime of labor, the very last thing you need is stressing over whether the cash is available when you require it. So folks maintained $5,000, $10,000, occasionally $20,000 or $30,000 simply sitting inside their checking accounts. Seemed secure, seemed sensible. But here's what shifted. And it shifted subtly with little fanfare, without a press briefing, and without anyone mailing you a notice. The IRS, along with financial regulators, have been strengthening their hold on bank account tracking. And the figure that's getting folks flagged, the figure that's abruptly placing retirees and average Americans onto a watch list, is $10,000. Now, you may have run across that figure previously regarding cash transactions. But what most folks fail to grasp is how widely that limit is currently being enforced and what unfolds when you remain consistently over it in your routine checking account. This is no longer solely about pulling cash at the teller counter anymore. This concerns your total balance sitting there day after day, month after month, and the patterns your account builds up over time. And for retirees who are collecting Social Security, pension payments, required minimum distributions, and perhaps some investment earnings all pouring into the same checking account. This is where matters begin turning complicated quickly. Here's a fact most folks have never been informed of, and I want you to genuinely focus on this section. Banks throughout the United States are legally mandated to submit what's referred to as a suspicious activity report, or an SAR, whenever they detect account behavior that appears inconsistent or out of the ordinary. Now, the term suspicious makes it sound as though they're hunting for criminals. And in the beginning, yes, that was the goal. The Bank Secrecy Act was crafted to identify money launderers and drug smugglers. But throughout the years, the meaning of what appears suspicious to a bank's computerized system has broadened considerably. And among the primary triggers, particularly for retirees, is a steadily elevated checking account balance, paired with unusual, sizable deposits or withdrawals. Your Social Security payment arriving on the 3rd of the month, your pension coming on the 1st, your RMD dropping in December. All of that can produce a pattern that an algorithm flags without a single actual human ever examining your genuine situation. And that's where the fresh IRS rule enters. And I want to be exact here because I recognize some of you will fact-check this, and you ought to. The present administration and the IRS have been advocating for broader bank reporting mandates. Under current rules, banks are already sharing transactions above $10,000. But the proposal that's been floating around, and in various altered forms already coming into force, would demand banks share gross inflows and outflows on accounts that surpass specific annual limits. The initial figure proposed was accounts with over $600 in yearly activity, which frankly seems ridiculous. But even in its more toned-down variations, the goal is obvious. The IRS wants greater insight into your accounts, and that translates to additional cross-referencing, additional automated flags, and additional letters showing up in your mailbox requesting you clarify your finances. Now, why does this strike retirees more severely than everyone else? And this is the segment where I truly need you to lean forward. Retirees are distinctively at risk here for numerous reasons. To begin with, you commonly have several income sources. You possess Social Security. You may have a pension. You may have investment portfolios paying out dividends. You could be liquidating property or drawing down from a 401k. Every bit of it flows somewhere, and most folks, for the sake of ease, channel all of it into one checking account. That account subsequently appears extremely busy to an algorithm. Big, steady deposits, big withdrawals, elevated average balance. Second, retirees frequently obtain sizable lump sum payments, an RMD in December, an insurance payout, the earnings from unloading a car or a plot of land. Those single big deposits are precisely the sort of items that set off automatic flags. And third, and this is the one that genuinely hurts, retirees are less prone to have a money advisor seated right beside them saying, "Hey, let's set this up more efficiently." Meaning the troubles pile up silently until they turn into genuine troubles. And I want to stop here briefly, because I recognize some of you are viewing this and thinking, okay, so what's the real worst outcome here? So, let me be candid with you. The worst outcome isn't merely receiving a notice from the IRS. The worst outcome is what follows that notice if you're unprepared. First, there's the audit. Not necessarily a complete face-to-face with an agent audit, but a computerized correspondence audit, where the IRS wants you to explain particular deposits or activity. That translates to paperwork. That translates to time. That translates to potentially bringing on a tax expert to reply for you. And tax experts don't operate for free. Yet a solid CPA or tax lawyer can charge you anywhere between $200 and $500 hourly. Then there's the possible matter of penalties. If the IRS concludes that funds you obtained were earnings you didn't properly declare, perhaps that sizable gift from a relative that someone didn't structure the right way. Perhaps those earnings from a minor sale you assumed didn't count. Abruptly, you're managing back taxes, interest, and penalties that stack on top of each other. For a person surviving on a fixed retirement income, that's not simply inconvenient, that's genuinely life-altering. And by the way, if you're still viewing this video, Ian, and I'm delighted you are, please do me a quick favor at this moment. Tap that like button and subscribe to the channel right this second if you haven't done so already. We release content specifically crafted to shield everyday Americans from the sort of financial pitfalls that the mainstream press skips over. There's plenty of noise out there, but we remain concentrated on what genuinely impacts your wallet and your retirement. So, click subscribe and let's continue, because we've barely covered half of what you need to grasp. Now, let's discuss the actual figure. The query this video posed, straight in the title, how much is excessive to hold in your checking account? And the truthful reply, given current banking standards, IRS review tendencies, and financial planning best practices, is this. Most financial advisors will suggest you retain no more than 1 to 2 months of living costs in your checking account at any specific moment. For the typical American retiree, that generally comes out to somewhere between $3,000 and $8,000. Now, that might seem unsettlingly minimal to some of you, and I completely understand that reaction. There's something mentally comforting about viewing a substantial balance in your checking account. It feels like protection. But here's the reality. That feeling is a mirage, and it's a mirage that's costing you in several ways. First, the plain one. Checking accounts pay virtually nothing in interest. We're discussing 0.01% at large banks in the majority of situations. Meanwhile, inflation is climbing at 2, 3, 4% each year. Every dollar parked in your checking account is losing genuine value with each passing day. In contrast, high-yield savings accounts, money market accounts, short-term treasury bills, and these are yielding 4, 5, occasionally even greater percentages currently. That indicates someone with $20,000 parked in their checking account, rather than a high-yield choice, is possibly forfeiting $1,000 annually or more in opportunity cost across a 10-year retirement. You're speaking about actual meaningful money that you gave up simply because nobody informed you there existed a superior spot to place it. Second, and this is the one that ties directly to our primary subject, retaining excess in checking heightens your chance of getting flagged. The longer your average daily balance stays over $10,000, the more your account appears like something deserving of scrutiny. To an automated system that has no clue you're merely a careful retiree who prefers the reassurance of a hefty cushion. The system doesn't recognize you, it merely observes numbers. And those numbers spell out a story that, regrettably, pattern-matching algorithms are now instructed to flag. So what should you genuinely do? Let me guide you through a workable approach that actually works for real folks in real retirement scenarios. This isn't hypothetical. This is what savvy retirees are genuinely practicing at this moment to safeguard themselves. The initial step is to divide your money into what financial planners refer to as buckets. Your checking account acts as your operational bucket. It handles bills, groceries, gas, and daily spending. It should carry just what's needed to handle your monthly costs comfortably, plus perhaps a modest cushion of $1,000 to $1,500 beyond that. That's all. Regard your checking account as a wallet, not a safe. You wouldn't carry your entire life savings in your wallet, and you likewise shouldn't park your entire life savings in your checking account. Your second bucket is your near-term reserve. This constitutes your emergency reserve, your rainy day money, the funds you'd tap if your vehicle broke down or you had a surprise medical bill arrive. This money ought to sit in a high-yield savings account or a money market account, ideally with an FDIC-insured institution. Hold 3 to 6 months of expenses here. If your monthly costs run $4,000, that means keeping $12,000 to $24,000 in this second bucket. And since it's in an account apart from your checking, it doesn't swell your daily balance, and it generates real interest for you in the process. Your third bucket, and this one is particularly critical for retirees, is your medium to longer-term funds. This is where you place cash you won't require for at minimum a year or beyond. Treasury bills, CDs, bond ladders, dividend-paying equities if you're okay with a bit of market exposure. These are all possibilities based on your tolerance, comfort level, and horizon. The essential point is that this money should absolutely not be parked in a checking account, generating nothing and drawing IRS notice. It should be laboring for you, producing real yields, and residing in accounts that are structured particularly for that goal. Now, let's discuss something quite particular that plenty of retirees overlook: required minimum distributions, or RMDs. If you're past 73 years old and you possess a traditional IRA or a 401k, the IRS obligates you to withdraw a minimum distribution annually. And here's the thing. Numerous folks obtain their RMD as a sizable lump sum in December, and they simply dump it into their checking account. That one transaction by itself can readily be $10,000, $15,000, $20,000 or larger depending on the scale of your retirement account. And that deposit strikes your checking account like a warning flare from the standpoint of computerized bank tracking systems. A much wiser strategy is to distribute your RMD throughout the year if your plan permits it. Take monthly or quarterly withdrawals rather than one large yearly one. This evens out the pattern, shrinks the size of any single transaction, and additionally aids you in handling your tax scenario more effectively, because you're not receiving a huge ordinary income event all at one time in December. Along similar lines, Social Security planning counts here more than most folks appreciate. If you're collecting Social Security and you're additionally pulling from retirement accounts, you need to be deliberate about the amount of your Social Security that becomes taxable. Here's a truth that startles many retirees. Up to 85% of your Social Security payouts can face federal income taxation if your combined earnings surpass specific limits. The greater the income streaming into your home in any given year, the higher the odds you push yourself into a steeper tax bracket and trigger increased IRS visibility. This is precisely why it pays, literally pays, to possess a plan, not simply a savings balance. Let me also address something that surfaces frequently in comments and discussions: the notion of just stashing cash at home to sidestep all of this. And look, I understand it. There's an attraction to the notion of merely possessing physical currency inside a safe where no algorithm can flag it. But I want to be candid with you. That method carries its own significant dangers. Cash at home lacks FDIC coverage, meaning if your residence burns down or you get burglarized, that money is basically gone. Cash holdings exceeding $10,000 can additionally spark legal issues if they're eventually uncovered and you can't establish the origin. And honestly, big stashes of cash tend to lose value each and every day just sitting there. It isn't the solution to this issue. The solution is intelligent account structuring, not stuffing money beneath the mattress. Here's an additional angle on this that we need to tackle: joint accounts along with family transfers. Numerous retirees obtain money from grown children, help with bills, gifts, contributions toward household costs, and numerous retirees additionally hand money to their kids and grandkids. Family financial assistance ranks among the most frequent and most misunderstood territories when it comes to IRS regulations. For 2024 and 2025, the annual gift tax exclusion sits at $18,000 per individual. That means you can hand any single person up to $18,000 within a year without it setting off a gift tax filing. But if you exceed that figure, even by a single dollar, you're technically required to submit a Form 709. Most folks don't realize this. Most folks have never submitted a 709 in their entire lives. And most folks have at some stage transferred a sum that, when tallied throughout the year, probably surpassed that limit without any monitoring or paperwork. This is precisely the kind of matter that begins as a minor oversight and evolves into a genuine problem should you get flagged for another matter and the IRS begins tugging on threads. Now I want to pivot and discuss something that's growing progressively significant in 2025 and beyond: digital payment services and how they intersect with all of this. Venmo, Zelle, PayPal, Cash App. These services have completely transformed how funds transfer among people. And the IRS has completely transformed how it perceives those transfers. Beginning with the 2022 tax year and expanding since then, the IRS has been rolling out new reporting mandates for third-party payment services. If you obtain more than $600 within a calendar year via a service like PayPal or Venmo for goods and services, that service is now supposed to send you a 1099K and share it with the IRS. This blindsided millions of folks entirely. Folks who were merely splitting dinner tabs or being paid back for a family trip abruptly started getting tax forms they had no clue were arriving. For retirees who might be selling items on Facebook Marketplace or eBay, doing occasional consulting gigs, or even just accepting routine transfers from relatives on these services, the exposure here is real. And here's where it links back to your checking account approach. Numerous folks have their Venmo or PayPal or Zelle tied straight to their primary checking account. Every transfer moves in and out of the same account, where your Social Security payment lands and your mortgage payment exits to the IRS's automated systems. All that activity gets weighed as one. It creates a picture of your financial existence. And if that picture is disorganized, even if every individual dollar is entirely legitimate, the disorganization itself can invite scrutiny. The tidier and more organized your financial arrangement is, the smaller your risk profile becomes. It genuinely is that basic. Let me steer this back to something workable and hand you a specific action plan, because I don't want you exiting this video with only worry. I want you exiting with a plan. Step 1. Today, not next week. Today, sign into your checking account and inspect your average daily balance across the past 3 months. If it's regularly over $10,000 and you lack a defined reason for it, you have to act. Step 2. Open a high-yield savings account if you don't already possess one. There are numerous online banks currently offering 4 to 5% APY with no minimum balance conditions and full FDIC coverage. Shift your emergency reserve there. Retain only your operational funds in checking. Step 3. If you're collecting an RMD, speak with your plan administrator regarding switching to monthly distributions in place of an annual lump sum. Step 4. Examine your digital payment services and confirm you grasp what's being reported to the IRS and what isn't. If you're selling goods on a regular basis or accepting steady payments, ensure you're documenting those and reporting them on your taxes. Step 5. And this one is the most crucial. Contemplate sitting down with a fee-only financial advisor or a CPA who specializes in retirement planning. not someone who receives commissions selling you products. A fee-only advisor who is legally bound to act in your interest. The expense of 1 or 2 meetings with a qualified advisor is almost surely less than what you'd pay handling an IRS inquiry down the line. Here's something I'd also like to address specifically for those of you who are married or in a partnership. Joint account approach counts tremendously here. Many pairs channel everything through one shared joint checking account. Both Social Security payments, both pensions, investment earnings, everything. The pooled deposits can readily push that account into ground where it appears highly active and highly balanced on paper. Dividing certain income streams into individual accounts, and while ensuring beneficiaries and account permissions are correctly established, can lessen the visual clutter on any one account and generate a tidier paper trail should questions ever surface. And let's discuss one additional matter that retirees regularly overlook: the connection between your checking account activity and your Medicare premiums. This is something termed IRMAA, the Income-Related Monthly Adjustment Amount. Medicare Part B, along with Part D premiums, rest on your modified adjusted gross income from 2 years back. That indicates what you earn and file today impacts what you pay for Medicare 2 years down the line. Large one-time distributions, unloading a rental property, executing a big Roth conversion, obtaining an inheritance that generates taxable earnings. All of these things can lift your income into a steeper bracket in 1 year and produce noticeably higher Medicare premiums 2 years afterward. It's not directly an IRS scrutiny concern, but it is a very genuine and very underappreciated result of permitting large sums of money to travel through your financial accounts without a strategy. The remedy isn't to earn less money. It's to arrange when and how you recognize income in a manner that maintains you below those IRMAA thresholds wherever feasible. I've covered plenty of ground within this video, and I want to do a brief recap so all of this remains with you. We discussed why holding too much in your checking account, particularly beyond that $10,000 line on a routine basis, puts you at heightened risk of getting flagged by your bank's automated tracking systems and by IRS cross-referencing initiatives. We walked through the fresh and shifting IRS reporting mandates that are making it more essential than ever to hold a tidy, structured financial setup. We provided you an actual workable framework, the bucket approach for where your money should truly reside, and why your checking account ought to operate more like a wallet than a safe. We went over RMDs, digital payment services, IRMAA, gift tax regulations, and joint accounts. All the pressure points where retirees are most susceptible to unintended financial exposure. And we handed you a 5-step action plan you can begin working on today.